if you're interested with the housing market and if you are wondering how the 2024 will look like, here is a breaking news for you guys.
Off with our top story of the day, the December jobs report coming in hotter than expected on the headline number. The U.S. adding 216,000 jobs during the month of December. Now, it is the first of a slew of data that the Fed is going to be getting before their first meeting of the year.
Hi, everybody, and welcome to Purpose Driven Life. This is Serdar. As you just heard, the job reports is out, and this is the first data point for 2024, which will actually help us to understand how 2024 will look like, not only from housing perspective, but from anything else when it comes to economics and financials. Now, but of course, the purpose of this channel, we focus on real estate, and therefore we will just try to untangle that report and try to understand what it means actually for the real estate. Now, there are actually 8 key data points that is used when we actually look into the future and try to figure out how the housing pricing will look like. And they are interest rates, inflation rates, unemployment rate, real GDP, government expenditure, S&P 500, mortgage rates, and money supplies. And again, for the purpose of today's video, we will just focusing on the unemployment and what actually it means and what's actually in the report. And at the end of this video, I will be sharing with you guys, what I actually think that report really means.
The job market is a vibrant, fluctuating entity, always in a state of flux. Today, we find ourselves in a scenario that is, to say the least, mixed. Delving into the latest job figures, we encounter a paradox. According to the Household Survey, December saw 683,000 fewer Americans in employment. Yet, the unemployment rate held steady at 3.7%. This seeming contradiction is due to 845,000 individuals exiting the labor force, no longer seeking employment. However, it's important to clarify that the household survey data, while insightful, is considered less reliable than company payroll data. The latter presents a more optimistic landscape, showing a gain of 216,000 jobs. This dichotomy between the two sets of data underscores the complexity of the job market. It's not merely about the number of people employed or unemployed, but also about those who are no longer actively looking for work, a factor that can significantly skew perceptions of the labor market's health. So while the household survey data shows a drop in employment, the company payroll data paints a rosier picture with a gain of 216,000 jobs. While the job figures are mixed, the impact on wages and interest rates is clearer. Average hourly earnings are on the rise, with a 4.1% increase to $34.27. This means workers are seeing a little more in their paychecks, which can potentially spur consumer spending and fuel economic growth. Wall Street's eagle-eyed focus on payroll data and wage inflation pressure is shaping the narrative about the Federal Reserve's future actions. There's speculation that the Fed might tread carefully when it comes to lowering interest rates. Why, you ask? Well, increased wages can signal inflation, and the Fed often uses interest rates as a tool to keep inflation in check. Now, let's talk about the benchmark 10-year Treasury yield. It's been on an upward trajectory which directly influences mortgage rates. As this yield increases, so too do mortgage rates, making home loans more expensive. The rise in Treasury yield is partly due to the speculation that the US government might have to offer higher interest rates to sell more bonds and finance its budget deficit. So, with the rise in hourly earnings and the increase in the Treasury yield, we might see a cautious approach from the Federal Reserve in lowering interest rates. Mixed job figures, wage increases, and fluctuating interest rates all have a profound impact on the broader economy. The addition of jobs, for instance, stimulates demand for long-term housing and commercial real estate. More people working means more people investing in properties, thereby fueling the real estate market. Now, let's switch gears to the bond market. The potential for a government shutdown and the need for higher interest rates to sell more bonds paints a more complex picture. Higher interest rates could make US bonds more attractive to investors, helping to finance the budget deficit. However, this also signifies a more expensive borrowing environment, which could dampen economic growth. Furthermore, a government shutdown could sow uncertainty, which is always a wild card in economic scenarios. So what does all this mean for the economy? Well, it's a mixed bag. On one hand, job growth and wage increases are positive signs. On the other, uncertainties in the bond market and potential government shutdowns could pose challenges. While the job market presents a mixed picture, the overall economic impact leans towards a cautious optimism, influenced by mortgage rates and the bond market dynamics.
All in all, guys, jobs are being added, raising long-term housing and commercial real estate demand. However, short-term dynamics are more influenced by the movements in mortgage rates and the bond market. So again, this is really early days of the year. Things are looking good for housing market, but we of course need to keep an eye on the data coming out, and will continue to keep coming out. Guys, if you are enjoying this content, please smash the like button and subscribe to the channel and share it with your friends and family. Thank you for watching, and I will see you next time.